Welcome back. This is your economic review. Now, a report by Business Daily indicates that a row is now ensuing between the bank executives and the regulator over the payment of dividends, with the regulator demanding high levels of capital buffers before payouts of the dividends. The report indicates the Central Bank of Kenya is citing the uncertainties in the economy as the reason behind the tough stance they have taken in the industry that has seen a change of law that now requires banks to get approval of the industry regulator before declaring dividends for the 2020 financial year, a move that the regulator says will ensure that the lenders have enough capital bases. Analysts are already predicting poor performance in the industry, a factor occasioned by mass provisioning for loans in the economy, with the non-performing loan book jumping to 14.1% by the end of the year. CBDK shows that the banking sector liquidity ratio closed January at 54.9%, the highest in 43 months. Only in May 2017, as it was above this level of 55.7%. Joining us this morning to help us go through this discussion is Joanne Moneke, a financial analyst. Joanne, good morning.
Good morning. Thank you very much for having me on the show.
Happy to have you around. Joanne, let's go through this basics. I mean, we're talking about liquidity in the commercial banking industry that is at 54%. That is above what is needed in the statutory requirement for the industry. Again, if you look at exactly how the banks are going by it, some of them are paying, some of them have said, well, we're not going to pay, depending on the way in which we look at ourselves inwardly. Some of them, like apps, have already cancelled that dividend payout, saying that if we look at that profitability level, then it's way below what we can do to support that dividend payout. KCB have paid 1 shilling, Cooperative have paid 1 shilling, Stanbic have reduced their payment by 46.2% to 1.5 billion. Then why are we talking about the CBK now going to these banks and telling them, well, you have to come to us again for us to give you that permission to pay that dividend, if indeed the banks are the ones that are supposed to make this decision?
I think that the CBK basically as a regulator just wants to make sure that the banks within liquidity levels are okay. The banks are not struggling to pay back their obligations. So for me, CBK is basically just trying to be a good regulator by regulating the banks and asking them not to come back to them and ask for permission to pay these dividends. The downside is that, of course, when dividend payout is not done, cash flow in the economy is, of course, curtailed. When people are not getting dividends, they probably are not encouraged to invest in the same stocks. So, of course, stock investment will come down. So I think there needs to be a balance with CBK in terms of allowing the banks also to work within their own structures and within their own policies, so that they can be able to balance the two in terms of their shareholders, return to shareholders, and at the same time maintaining their liquidity. So for BCBK, I think needs to look at those, to create a balance between the bank coming back to them and them being able to be allowed to work within their own just independent and being able to be autonomous in terms of being able to make their own decisions as far as cash management is concerned.
Yes, Joanne, but just before I cross over to Joash this morning as well, but it's astounding how we're talking about a liquidity level that was only recorded back in 2017. Is that not a signal that then the banks can actually make the decision when it comes to this dividend payout?
Of course, we've seen that it's true that the banks can make the decision, but the same banks have also failed in terms of see maintaining their, what do you call it, being able to maintain their customers in terms of, let's give an example in terms of what happened in the past few years
Yes.
with the Imperial Bank, with the Chase Bank, the banks that actually went under. So I think CBK is trying to be careful in terms of just making sure that banks are also operating within their required minimum, just to avoid, to protect the customer in himself. The customer was put money there, and the fact that the customer needs to get his money as and when it's needed. So in terms of what we saw in earlier years, that the banks coming down, the bank shutting down customers' money, that was also a big blow in terms of CBK's. In terms of how is it regulating the banks.
Yes.
So CBK is just trying to be careful in terms of just making sure that the banks are still within operational levels.
All right, let me bring in Josh as well. Josh, let's really look at exactly where we're coming from as we ask the question: is the CBK over-regulating this industry? Now, let's talk about where we are now. APSA is the one that has already cancelled that dividend payout, saying that their 43.8% profitability drop will not enable them to actually get into dividend payout at the end of this year. Fine. KCB, which recorded also a profitability dip, was able to retain 1 shilling per share dividend payout. Cooperative Bank recorded a profitability dip, but were able to pay 1 shilling per share as well, dividend payout. Stanbic, which has already given us the results as well, profitability dip, but they reduced that dividend payout by 46.2% to just 1.5 billion as we wait for what that will translate into dividend payout per share. Fine. If indeed, Josh, we are talking about a liquidity level of 54% and it's healthy, this was recorded all the way back in 2017, then why can the CBK say, well, make that decision, pay what is within what you can, as opposed to them saying, well, come to us, let's clear you first before you start paying that dividend?
Yeah. If you look at because the article quotes a row between the CBK and banks.
Yes.
I don't really see a row, because what CBK did is they said for this financial year, you need approval from CBK to pay out dividend.
Yes.
It doesn't affect subsequent financial years. Maybe they might extend it for a year or two. But what we are looking at in terms of profiles of the African banking sector is, if we have a rapid recovery, then we are looking at pre-COVID levels from the year 2022. If we have a slow recovery, then we are talking 2024. So I think the banks are alive to this. So even the legacy payers of dividend, you mentioned ABSA, for example, has always been a legacy payer, cancelled their interim dividend payments. So I don't think there is actually a conflict between the thinking of the banks and the thinking of the CBK.
Yes.
When the CBK put in this rule, I think in August of last year, they were just being precautionary, because at that time it was difficult to tell. And when you're dealing with banking executives who also have to think about their share prices, then as a regulator, you have to be concerned that perhaps they might make dividend payouts that are not pro-business, just to maintain their share prices on the stock exchange. So I think the CBK was just being precautionary, but I also think that the banks themselves understand that they are not in a position to give the typical payouts they used to give in terms of dividend.
Yes. Josh, from an investment perspective, those who pay would tend to give a stable outlook. Is that what it is? Is that what now would be looked at as a row between the CBK and the bank bosses across the country? Because if you don't pay, then, well, there are questions as why you can't pay, as opposed to paying even just by a little, like what we've seen KCB do and Cooperative do.
Yeah, and you have to recognize, Simba, that even those payments that KCB and Cooperative and so on and so forth are doing have been approved by the CBK.
Yes.
I think the issue, what might be a row is, are you paying, and is your ability to pay reflecting in your books, or are you paying from a cosmetic perspective just to maintain appearances, to keep up appearances.
Yes, Josh, but well, we do know exactly what is going on right now in the economy. There have been mass provisioning, and if you look at exactly what we're talking about, let's for example, APSA's gone, the provisioning for loans has gone up by 115%. We do have the likes of KCBs that saw more than 250% provisioning for these loans. You like to think that indeed, when it's a known case that you have really provided for these loans on an exponential level, that you can expect for us to have a lot of capital buffers, which the CBK again is calling for right now. Is that where the clash is from? Because the clash is, you can pay, but then as well, you need to have a capital buffer that we deem is satisfactory. Is that where the row is?
Exactly. I think that is where there's a conflict in thinking.
Yes.
I think it's in the capital cushions that the CBK is demanding of the banks.
Yes.
And one of the ways to maintain those capital cushions obviously is not to pay out dividends. So I think that's where the conflict is coming in. You're right.
Pretty much. All right, John, if indeed that's where the row is coming from, then are we going to say that for the next, 1, 2, 3 years, that we should be expecting dividend cancellations from the banking industry in the country?
I think that the bank should actually maintain the minimal payout. Remember,
Yes.
this is a ripple effect in the economy.
Yes.
So these same payouts, where people have huge shares in the same, would translate to loan repayouts, and that kind of liquidity in the system. So even the banks, when CBK have to work together to maintain a situation whereby payout means that the effect on the economy, there's an effect on the economy in terms of repayments of loan, repayment of just this money and system moving in the economy. So I think that the bank should still maintain the minimal, payout. There should be a balance. And of course, that should be worked out with CBK. So that because there's a ripple effect on the economy also. So that there's a balance. There's a creation of a balance in terms of this money also moves back to the system in terms of loan repayments, in terms of banking, in terms of money going back to the same bank.
Yes.
So there needs to be a good rapport between the banks and CBK in terms of what you can pay and what cannot pay out within the next. Of course, keenly working together in the next year and the next coming year to 2024.
Yes. John, what is your prediction of the banking industry's performance in 2021? Well, there's this optimism from the National Treasury that, our economy is going to rebound again this year for us to hit close to 6.2% prediction. If indeed we don't get back to that level, what's your prediction really over the performance of the banking industry in 2021?
I think that the banking performance, in my assessment, will grow very marginally or very little.
Yes.
Because, we are still struggling with getting the businesses to get back on track. Of course, we had a challenge with our fuel prices, which means that costs of operation of business has become very expensive.
Yes.
The same businesses are banking in the banks, putting the extra money in the bank or borrowing from the bank. So for me, I think 2021 will still be a tough year for the banking industry. It will not be as good as predicted. Because of course, in the last 3 months, we haven't seen a significant increase in terms of economic performance.
Pretty much. Now, just before I cross to Josh, John, let's look at it from this perspective. I know we're still waiting for results from the lower tier banks in the country. I mean, what we have so far, we've already seen APSA, which is a bigger bank in the economy, that has already cancelled that dividend payout. Let's look at Cooperative, just 1 shilling, KCB 1 shilling, Stanbic cut it by 46.2%. Their total payout is just going to amount to just 1.5 billion shillings. Which therefore begs the question, John, if these are the big boys that we're talking about this morning, what of the smaller boys? I'm talking about the lower tier banks. What is going to be the effect?
I think the smaller banks will, I don't expect them to match with the big players
Yes.
in the of course. I think they may not even have a big dividend payout this year. I don't think they'll outperform the bigger bank. I think will be the trend will be the same or even non-payment. Yeah.
Pretty much. Josh, let me bring you in on this as well. What we're riding on is optimism, and there's a number that has been set also, that's 6.2%. Let me start from there, because if we're going to talk about the performance of the banking industry, then we really have to look at the way that the economy is also responding in 2021. What is your prediction of our economic growth this year? Are you also on the 5.9 to 6.2% rebound that has been predicted? If at all we're going to talk about the rebound or better fortunes within the banking industry.
I think 6.2 is a bit ambitious.
Yes.
And I remember a couple of weeks we were discussing on the show where sometimes GDP growth can be reflected in the public sector and not in the private sector.
Yes.
So if the government is doing an expressway from the airport to Waiyaki Way, that will count as GDP growth, but that doesn't necessarily mean that the economy is growing, particularly in the private sector. So I think 6.2 is a bit ambitious. And
yes.
Just like the doctors and nurses are frontline workers against the pandemic, the banks are the frontline workers against the economic pandemic. So the banks are most sensitive to whatever is happening in the economy. And so I think, again, as I said, if there's a quick recovery, then we have to expect, not just in Kenya, but across the continent, if there is a quick recovery, then we expect the banking sector to go back to pre-COVID levels in 2022. If the recovery is slow, then we're talking at earliest 2024.
Unless 2024. Let's move on to the next issue that is actually also related to whatever it is that we're talking about this morning. Restructured loans. All right. Now, loan defaulters have been put on notice. Now, these are the borrowers who defaulted on their loan repayments. Now, bank borrowers who defaulted on their loan repayments after the 2nd March of 2020 have until 3rd June of 2021 to restart repayment of the loans. Now, in a statement, that's yesterday, the Central Bank of Kenya, CBDK, and said borrowers whose loans were performing before March 2nd last year but were restructured and subsequently went into arrears will have 3 months to regularize their loans. In March last year, CBDK announced emergency measures to mitigate the adverse economic effects on bank borrowers from COVID-19 pandemic. Among the measures was restructuring by banks for a period of up to 1 year of loans that were performing as of March 2nd, 2020. With these measures, borrowers were provided with various restructuring options, including extension of repayment periods, moratoriums on a principal or interest, and waivers on an interest or fee. Let's again look at that data that we've been giving you this morning in terms of what the non-performing loan book has been throughout the entire of 2020. But Richie, can you jump into, yes, that's the gross non-performing loans trend all the way from 2017 to 2020. And you can actually see that as from March of 2020, that's when we had that spike in the loan book, which we do know led us all the way to 14.1%. John, this is really interesting. Now, we do know that you have to get back to repaying your loans under the normal terms that you took the loans before March of 2020. That's third. But John, let's look at exactly what has happened within that period. Equity Bank, again, just before this announcement, they said they've extended a 3-year moratorium period again for anybody who thinks that they cannot actually get back to repayment of their loans, should they also go in and prove as to why they cannot actually pay that. But the CBK, on the other hand, is saying, well, go back and repay your loans now or else. So where do we stand? Go back to repaying, or for any other person who feels that they cannot repay their loans to go back to the bank and say, well, we do not think that we can repay these loans, therefore extend the moratoriums as Equity Bank is doing on the other side?
I think, Simba, let's be honest, that things have really been, of course, very tough in the past 1 year.
Yes.
And now with the third wave of COVID, and people are trying to get back into business. I don't see a situation where people are still able to make payments for their loans. One being that businesses had shut down and are now trying to restart. People who are on half pay, meaning that people are now still trying to get their basic, needs in terms of food, shelter, transport, school fees. Now, the school fees is being paid again. So, in terms of ability to pay loans, the consumer loans, I think. That will be a challenge for people in terms of businesses that have taken loans to, maybe do expansion, haven't been able to recover their money back yet. Therefore, repayment of loans, of course, is still going to be a challenge. And I think that CBK should talk with the banks again in terms of just the ability to, to allow people to extend the repayment of their loans. Of course, in conjunction with the banks, knowing, the banks know their customers, obviously.
Yes.
So if you see Equity as saying that we can now extend for another 36 months, it means that they have spoken to their customers, they know their customers, they understand their businesses, and that's why they have decided come back and let us talk again instead of us saying, okay, instead of you going under and just keeping quiet, come and let's talk again and let's see how you can extend repayment instead of non-repayment. Absolutely. So I think that CBK needs to lend an hearing ear to the banks in terms of just allowing them to work with their customers who they understand as far as loan repayment is concerned.
All right, Josh, is it a right? And we had that conversation again when we were going through these measures that the CBK did just to protect the economy from the effects of the coronavirus pandemic, even the wider measures that were actually put in place by the government. 1 year, that's exactly what we're given. But now you have to go back and start repaying your loan. Are we under the assumption that, well, the economy is back running again? Is that a wrong assumption from CBK?
I don't think that's the assumption the CBK is making.
Yes.
And if that's the assumption they're making, then they're very wrong. Because, again, as Joan mentioned, we are now going into a third wave. And apparently this one is even worse than the first and the second. So we're going to see again in 2021 some serious economic effects. I think the CBK is walking a very tight rope because on the one hand there is a need to protect the consumer,
yes,
to protect the banks, but at the same time not seem like you're over-regulating. So I think when CBK says you need to go back to payments as before, is basically what they're communicating to Kenyans is, we had given you as a consumer a protection of a year.
Yes.
And that year is done. Now we leave it upon the banks to decide how they're going to deal with you going forward. Because the 1 year moratoriums were compulsory. Every bank had to comply with that. But I think now CBK is saying we are allowing now the banks to make their own decisions going forward. So I see many other banks going the equity way,
yes,
and extending those moratoriums. But I think CBK is trying very hard not to seem like they are over-regulating the industry.
Yes, when we come back, Josh, from this tiny break that we're taking shortly, I would like to ask you, though, that indeed, if we are not so sure, therefore, of when the economy is going to rebound, could have the CBK come in and say, wow, again, we are extending that period for anybody who thinks they cannot repay their loans, so that it's within law for the banks to act on those who cannot repay their loans, as opposed to that decision being left to the banks. We do know the banks are in business and they may want to push the customers to their last end. Once we come back here on A Business I Am from this tiny little break.